Good evening, ladies and gentlemen. Welcome to my final project. My name is Paul Perkle, and today I'm going to be discussing bonds and bond valuation with everybody this evening. So sit back, relax, and strap it down. Let's get started. First, I'm going to give you a basic overview of what we're going to be talking about this evening. First, I'm going to give you everyone a refresher of the basic definitions of bonds, par value, maturity date, and things like that, just so we can refresh what Chapter 7 already taught us. Then I'll be discussing how bonds work, your types of bonds, coupon rates, bond markets, bond valuation, your bond ratings, and the criteria and the importance of those bond ratings for the investor. First, your basic definitions. A bond is basically a long-term debt. Par value is a face value of your bond. Par value will be listed on your bond. It'll be a piece of paper that says $1,000, for example. That's your par value. Coupon interest rate is your annual interest rate of your bond. There's a certain percentage that the bond will give you over the period of time. Once the bond reaches the maturity date, which is the date that the par value of the bond must be repaid, that coupon interest rate will go into effect. How bonds work. This is probably the most important concept that I can stress to everybody here is how these things work. How investing into corporations will make you money. Think of a bond as basically a loan to an organization. A company promises to pay back your loan with interest, which is your coupon rate. Once your bond reaches that maturity date, that bond principal, the amount you already give, and the interest is paid back to you, and it has to be paid back. So it's a legally bound contract, if you will. There's different types of bonds you can invest in. First is like a treasury bond, which is a bond issued by the federal government. Corporate bonds are bonds issued by corporations, and a lot of bonds are traded this way. Municipal bonds are bonds that are issued by state governments and local governments. Excuse me. Foreign bonds are bonds issued by foreign governments. That makes a lot of sense, doesn't it? Your coupon rates. Stuff that are pretty simple here. Fixed rate bonds as the interest rate is fixed. A floating rate bond is a bond interest rate that fluctuates with the shift of the general level of your economy interest rates. Zero coupon bond is a bond that has no annual interest rate but is sold at a discounted par value, which means, say you have a bond that's has a par value of $1,000. You'll buy that bond for, say, for example, $800. And after, say, it reaches 10 years to reach maturity, you'll make $200 because you bought it at a discounted price. So not a lot of risk involved with something like that. It's actually kind of nice because you know exactly what you're going to be getting. There's different types of bond markets, but most bonds are bought and sold by very large companies. Companies will use it to bring in capital and things like that. Wall Street Journal reports bond markets and bond ratings daily, so it's something that you guys can even do right now to see what the bonds are trading at. There's also a concept of over-the-counter bonds, which is basically a market that people like you and me can buy and sell bonds to make money. As far as bond valuation go, the book gives us a pretty interesting equation on how we can value a bond for ourselves. It's written on the screen here. But important thing to remember is that on the equation, RD is the coupon rate and INT is your interest rate. So you can follow along in the equation here, and it'll give you a bond value price of what the price is for your bond. A couple of things to remember is that an increase in your interest rate will equal a price of the outstanding bond to fall, and a decrease in the interest rate will make a bond price equally rise. As far as bond ratings go, there's three major agencies that report bonds. You have Moody's, Standard & Poor's, and Snitch's Investor Service. Those three bond rating companies rate the bonds. Your most safe bonds are AAA bonds and AA bonds. Anything else made like a grade B or A bonds or triple B bonds are considered investment grade bonds. Any bond that's a high risk, high yield is considered a junk bond. As far as bond rating goes, there's different criteria that affect the bond rating. First and foremost is your financial ratios, the contract terms of the bond itself, the overall economy, how the economy is doing, the company sensitivity to the economy, if it's, say, a corporate bond, and inflation. Inflation does a huge effect on bond ratings. Why are these bond ratings so important? Well, it basically gives you an idea, an investor, of the risk you are facing. If you're buying, say, a AAA bond, there's very little risk that you're not going to get a large return. AAA bonds usually give a lot more return than say like an investment grade bond. So if you can get something like that, you're in good shape. You have to keep in mind that ratings do not change right away. The book gives a really good example of the company Enron. Enron's ratings were too good 2 days before they went bankrupt. That's pretty scary. So if you're not paying attention to what's going on, you might get into an investment that's very bad. Basically, to sum up everything that I've talked about this evening, bonds are loans that are paid back with interest. Bonds have different ratings and are rated by 3 different investment corporations. Bond, even for us today as students, it's a good investment. Uh, I make the argument that it's even less riskier than the stock market because you put money in and you know you're getting a return for it. You put money into say the stock market, you may get a good return or you may not. It really depends on a bunch of different factors. So anyway, that's my presentation. I hope you guys enjoyed it. If you guys have any questions, please feel free to comment. I'll be happy to answer for them. And I'm really looking forward to seeing your videos. So take care. Great working with you guys all this semester. And good luck to you and your careers. I know God's going to be working great things in all your life. So take it easy. Bye-bye.